If you know the relationship between the four main asset classes on the planet, then you can tell the difference between a stock market correction or a stock market crash. And you can see stock market corrections and crashes coming before anyone else is talking about them. Hey guys, there are four main asset classes on this planet. Now you've been taught to be diversified into each one of them. What I'm going to show you in this video is why being diversified in each one of them actually unnecessarily slows the growth of your money and has you unnecessarily take the full crash of a stock market. Okay, so let's get into the three things I'm going to cover. Cover number one, I want to talk about what the four asset classes are. Okay. Thing number two, I want to talk to you about why the relationship between them matters most. And then number three, I want to talk about the order or the strength of those four asset classes and why that order is what matters most to the stability of the growth of your money, to your future, to your consistency, to your certainty, to good night's sleep. Okay, so let's jump into this. We have been taught to over-diversify. We have been taught to go into all the asset classes. So what are the four asset classes? Number one, stocks. People can call them equities if they want to look smarter, but we're going to call them stocks because that's what they are. Some people call them shares if you're in a foreign country. Stocks are shares. So that's ownership in a publicly traded company. It can also be ownership in a privately traded company. We're just going to focus on the publicly traded ones in this video, but it's part ownership of a company. Okay, and most of them are publicly traded companies. So asset number one is stocks. Okay, asset number two, in no particular order, is bonds or cash. Now I'm putting bonds and cash together and I'm going to call them fixed income. All right, so right now I'm just going over the four asset classes. So fixed income, very straightforward. Cash, think of it like a one-day bond. You're giving your money to the US government, okay, and they're giving you back $1 and it's sitting in your account. This is kind of a different way of looking at fixed income, okay? Or you can give money to the US, say for 90 days or for 3 years or for 10 years or for 30 years. Those are called bonds. So you give the US government, in this example, say $1 million. And back in 2000, they'd give you about $65,000 a year in interest. All right, that was the yield on a 10-year bond. Most people could live off that. So that is what a bond is. You are giving your money to a government. It could be federal, it could be state, it could be a municipality. Okay, and they are saying to you, we're going to give you your money back. And in the olden days, we're going to give you basically an annual stipend. Okay, but that's called a bond. So bonds and cash, I'm calling that fixed income. That's the second asset class. The third asset class in no particular order is real estate. Now, the real estate I'm talking about is the real estate that if it fell on you, it would probably kill you. So actually owning land or owning a building or owning a second home or owning investment property. That's what I'm talking about when I am speaking with you about real estate. It's actually owning the buildings, owning the land. That's real estate. It's not a tracking symbol. It's not a real estate investment trust in the stock market, but it's actual physical real estate. Okay. And then the fourth and last in no particular order is commodities. And just think of this as the grocery store of the world. About half of what makes up the whole commodity world is energy, but it's broken into energy, softs, metals, grains. So just think of it as kind of the refrigerator or the grocery store to the world. So you have four assets, okay? You have stocks, fixed income, real estate, okay, and commodities. So those are your four asset classes. Now, we've been taught to diversify into all of them, and I believe that's a mistake. And I'll get into that in a little bit. Okay, so the second thing is, it's not being diversified, but it's knowing what the order is or knowing what the relationship is. So let's just think about this for a second. The stock market has a history of beating the other three asset classes. So depending on what country you're in, but in this country, let's just say the stock market is about 120 years old. So in the US, there's about a 120-year history where the stock asset class is outperforming the bond asset class and the real estate asset class and the commodity asset class. Now, when this is going on, okay, when you have that performance of stocks beating the other three, okay, and not changing, this is telling you there is an incredible amount of stability in the stock market. And the reason you want to know this is because you're going to be hit, okay? You're going to be hit with news. You're going to be hit with confusion. You're going to be hit with overwhelm. You're going to be hit with hype and fear and rage, okay? But if you know that if stocks are in the lead of bonds and real estate and commodities, then you know that's the stability. And this is really important because there are periods of time where stocks aren't the lead of the four. So think of it as like four horses running around a track: a stock horse, a fixed income horse, a real estate horse, and a commodity horse. If the stock horse is in front, the stock market is in very strong hands and it's very stable. But if it's in second or third or fourth place, you do not need to read the news. Something is really bad going on. So here's what's neat. If you know the order, you know the stability of the stock market. Okay, so number one is what the actual asset classes are. Number two is the relationship between them. That's what the key thing is, to know the relationship between them, not to be diversified into it. And like I said, when stocks are first, it almost doesn't matter what is second, third, and fourth, but if stocks are the lead asset, okay, then you have a strong stock market. And then the third thing is the order matters. Right, I kind of put the second and the third together, but now I'm teasing them apart. The order matters. So when stocks are number one, then you know the stock market it's in a very strong position. Now, why does this matter? It's very, 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 very difficult for instability to come into the stock market if the stock asset class is outperforming bonds and real estate and commodities, right? Because I want you to think about this. There's only 4 places on the planet to put your money. If your money is stuffed under your bed in cash, that's part of fixed income. So you're still invested, which is kind of an interesting concept if you think about it. You are always invested at any time in one of these 4 asset classes. Now, what we know is the cash asset class, depending on what country you're in, but here in the US, falls in value and price about 3% a year. And most currencies are like that around the planet. I'm talking about fiat currencies. Fiat means having the full faith of the government behind it. So you definitely don't want to have your money in cash for long periods of time because it has a 100+ year history of going down every year. So think about the situation where someone collectively, a group of people called investors, they're taking money out of the stock asset class and they're putting money in the cash asset class. I mean, what's the mindset of someone who's doing that? And I'm talking collectively, not just one person, okay? But, millions of people collectively pulling money from the stock market and putting it into cash. It could be US dollar, it could be Japanese yen. It actually doesn't matter, right? And cash is a part of fixed income. So if that's happening on this kind of this crowdsource level, this collective level, that means people are scared about the future because people do not put their money in the stock market, right? When they're scared about the future. Where do they put it? They put it in cash or they put it in bonds, right? But they move it over to fixed income. So the relationship between stocks and fixed income, okay, which is a big part of what this video is about, it's the relationship that matters most. So if all of a sudden fixed income is outperforming stocks, okay, and this happens almost before every major market crash where bonds and cash start outperforming stocks. And when that happens, that tells you there is a shift coming. And this will show up in the relationship between specifically these 2 assets, way before you're going to see it on CNBC, MSNBC, or any of the noise or news outlets. So knowing that relationship is important. Real estate's a very interesting asset class because it kind of is over by itself. Okay. Very often when I work with someone, they will be paying off their house or their house will be paid off. And just for easy math, let's just say their house is worth $500,000. Okay. And let's just say for easy math, they have $1 million in the market. So they are diversified in the sense that not all of their money is in the stock market. What's nice about real estate is if your house falls in price or value by 30%, you don't see 30% less of your house. Like the entire house is there. And so a lot of people actually like real estate because even when the market is going against them, okay, they can still see the house. Now, of course, there was a global financial crisis and it was on the back of anyone being able to get a mortgage. The point is people often like to have a portion of their money in real estate because they can see it. And it used to, this is super important, it used to be non-correlated to the stock market. But today it is very correlated because as the stock market goes up, people have more money, they pay more for a house, they want to get a bigger house, and the stock market goes down, they have less money for a house, they may need to sell their house, they're certainly not looking for a new house. So there's a lot more correlation going on in these four asset classes than there were, say, in the 1970s. Okay, and then that last one, commodities. Commodities, they go through long periods of uptrends and downtrends. The last major uptrend was from 1970 to 1980. And that often tells you about inflation, right? So that's where you're actually going to see the inflation coming. So I want to wrap up the video and talk about the three things that I said I was going to cover. Okay, one is to know what the four asset classes are. There's not 40 asset classes. There's not a new asset class. Crypto is not a new asset class. It's either a utility, it's either a currency, or it's something else, technology, but it's not a new asset class. So knowing there's only four asset classes is what matters most, okay, in that relationship. Number two, the relationship between them is way, way, way more important than being diversified in all of them. And in fact, I think it's a mistake to say I have some of this, some of that, and some of that, and some of that. Almost like they're checks, you're checking boxes on some piece of paper. And perhaps the most important part of this video is the relationship or the order of strength between the four asset classes is what matters most. Stocks in front, almost anything behind it means stock market is in the hands of the strong and it's going to continue growing. And when that position changes, that's typically the beginning of when the market's going to have a very hard correction or go into a really serious crash. But it's the relationship shift from first place of stocks to anything but first place that really starts to potentially show you that a market crash is coming. Thanks so much, guys. Please go ahead and hit the like button because it makes a difference. And if you like this video, you're going to love the other videos I have for you. Okay, thanks. And I will see you next time on the next video. All right, bye.